What I'd like to do now as part 2 of income tax is to walk through a basic overview of how business taxation is structured and some of the things in it that not only make it complicated but also that benefit corporations and why. The first thing is to understand there are two types of corporation. What we call a CCorp, which is a traditional corporation. It's taxed at the corporate level. There's continuity of life, centralization of management, free transferability of shares. You can change ownership around. For the shareholder, there's limited liability, but there is the potential of double taxation. It's taxed at the corporate level, and when it's passed out to shareholders, it's taxed as a dividend. Then there are S corporations, and S corps under subchapter S of the IRS code. It's a corporation which has all of the benefits of being a corporation from a liability sense, from a transferability, for a funding sense, for an ownership sense, protection for risk. However, the income is taxed at the individual level, so it's passed out of the corporation to the individual, and that avoids double taxation. There are certain limits on how many shareholders you can have, and you have to make an election, and once you do it, it may be revoked and returned to a regular corporation. So let's just see what happens from a tax perspective. Here we have a C Corp, regular C Corp. Corporate income, say, of 100. Corporate tax of 21 means net to the corporations of 79. Now, if you paid that out to the shareholder, and they would pay, say, an average at their rate of 18.8%, 1485, net to shareholder would be 6415, or a tax rate of about 36%. Now, let's look at a pass-through. There's the business income. You get a special deduction of 20%, which leaves taxable income at 80, income tax at the personal level of 24, and 19.2. So the business owner income is 100 less 19.20, it's $80.30, tax rate of 19.20 versus 35.36. So there is a benefit as a pass-through based on the taxable income married filing jointly up here. So you can see here's the example of the double taxation. So in many small to medium-sized businesses, if they meet the criteria, they can actually have a more effective tax rate. The tax rate's changed. Today it is flat rate 21% for everybody, and prior to that, if you made 0 to 50, it was 15%, so you're going up. 50 and up, you've had a reduction. So 50 to 75 was 25, went down 4%. 75 to 10 million was 35 to 21. So it was really the big corporations that really benefited from this. So you say, well, why did they want to do this? Well, to spur investment, to create jobs, make business more competitive. So in addition to changing the rate, what they did is they had bonus depreciation. Expanded what that is, meaning that from 17 to 22 you can deduct 100% as bonus deduction, and then it moves out 80, 60, 40 and phrases out. It was expanded to include used property. Previously only had new, but the intent was to influence companies to make more investments in property and plant and equipment, thus spurring economic growth to increase productivity and efficiencies nationwide. So there's a huge benefit for buying new equipment. Currently, a taxpayer may expense up to $500,000 of property. However, this is phased out if a business has placed over $2 million in service during the tax year. So what it does is it really is increasing the expense limit on 179. And that, they expanded the definition of what's in that. Tangible personally, it used to specifically exclude furniture used to furnish lodging in hotels, improvements to non-residential real property placed in service was first place in service. You could break it down to roofs, heating, ventilating, and air conditioning, fire protection and alarm security systems. You didn't have to, you could still write them off. In the past, you couldn't. They then said, well, okay, businesses with average gross receipts, that's sales, that do not exceed 25 million are exempt. Okay? And the proposal disallows interest expense in excess of 30% of a business adjusted taxable income. So what they've done is they've disallowed certain interest expenses. And they, of course, made it very complicated by excluding certain real property and construction businesses, farms. But again, they tweaked that to try to minimize the use of leverage and debt. Net operating loss deduction. Under current law, it could generally be carried forward 20 years and back 2. The legislation now limits a net operating loss carryover to offset 80% of taxable income, not 100. 90% for alternative minimum tax. So it would eliminate carrybacks, and they could carry forward indefinitely. So that was some of the tweaking to, again, try to benefit companies, and some, of course, got hurt. Now, we talked about permanent. The things we just talked about are all timing differences for the most part. When we look at the permanent differences, things like entertaining clients, meals for employees while traveling, provided for the convenience of employer, and fringe benefits, they simply disallowed some of them. You can look at this chart, but essentially these are the examples of some of the permanent things. They then went back and said, well, there's certain limits on executive pay and total compensation. It tightened it up a year, but it did allow certain performance-based to be deductible. In others, they couldn't deduct. They introduced the Territorial Tax System. Previously, we had the highest rate, 35% in the world. So under the old system, a company doing business in the UK would first pay the UK rate of 19%, and then when profits were sent back, use the word repatriated to the US, there'd be an additional tax of 16. Okay, so the goal, what happened is that the goal was it was companies incorporated in having headquarters in the US paid a tax of 35% no matter where the income was earned. So that's when we started to see US companies moving to a lower tax jurisdiction, primarily Ireland. And they didn't pay US taxes on non-US earnings. So think about this for a second. If I did business in the UK and I paid 19, if I tried to bring the money back to the US, I'd be taxed at an additional 16% to get to a total of 35. So if I kept the money out of the US, as long as I was headquartered outside the US, say in the Bahamas, in Ireland was a big place, they didn't pay tax. So it was a beneficial move to do that, considering the tax rate in the example you're seeing right now was about 16%. So under the act that was passed, they introduced a territorial tax system, and the way that works is multinational corps would no longer face that additional domestic tax on their foreign profits when those profits are back to the U.S. They were keeping the profits overseas. They never brought them back. So introduced that, and essentially what that did is it allowed it to be taxed at the rate in the country in which it was earned. Now, of course, there was a tax that they wanted to get all this previously income earned out the U.S. taxed. So what they did is they imposed a tax on the unremitted earnings, and they had 8 years to pay it at a rate of 12.5%. So it gave them flexibility going forward, but bringing back any other money that had not been repatriated, they had to pay an additional tax. They also did some things with intangible low taxed income. And again, they tried to prevent losses from happening in the U.S. and gains elsewhere. And then they had a global intangible low taxed income, guilty inclusion. And the way that worked is there's a test, deems intangible return, goes through a huge computation. And as a result, you can look at all of this. They were able to exclude certain income. Certain industries got certain benefits. It was done for not only to benefit companies, but there were exceptions carved out for political interests. So, impact on foreign corps? Yep, worked quite well. The Tax Act has been a huge benefit to American corporations. Huge impact. Corporate taxes, and you're going to see this when you do Project 2 and you look at what that tax rate is. You're going to see the millions and millions of dollars that were saved. However, the implementation, as you can see by some of these things, and that was my purpose, was really to help you see what some of these timing differences are, what some of the permanent ones, but also the complexity of the tax code. And that's why you have to go back and look at the notes to financial statement to understand what it is. So you've now got a big piece of the analysis done, and you can interpret it now. If you have any questions, please let me know.